I'm Scott Frame from the Dallas Fed, and welcome to this panel session about evaluating post-crisis financial reforms. Usual disclaimer applies. I just wanted to offer a couple sort of opening remarks, and then we'll go ahead and turn to our panelists. So much has changed for the banking sector in the decade since the financial crisis. I think that should be pretty obvious to most of us. Central banks have reduced their policy rates to the effective lower bound and engaged in quantitative easing. And while we had a little bit, albeit seemingly temporary, liftoff in the U.S., we're now beginning to ease monetary policy here. Europe continues to experiment with negative interest rates. There's a new global regulatory framework. It's sort of encapsulated by Basel III with heightened capital and liquidity standards, and also the introduction of Macro-Prudential policy tools aimed at muting credit cycles. We've also seen, and I think there were a few sessions that touched on this at the meetings, about the emergence of new shadow banking institutions under the rubric of the broad intent of fintech. And so there have been an awful lot of very significant and important developments that have affected banking around the world in the last 10 years. And I think the outcome of this is that traditional banks, especially the largest ones, we can see this pretty obviously, that there are pretty depressed valuations for these institutions as well, and it starts to raise questions about whether there's really value in a commercial bank charter. So with that as sort of a backdrop, the panel today will begin with a little discussion about post-crisis regulatory reforms with an eye towards the research literature. I mean, the aim of these sorts of panels, I think, is to deliver a little bit of knowledge, but I think to have senior people that can also offer some directions for future research. Along those lines, Bob DeYoung from the University of Kansas is going to begin by offering his thoughts about liquidity regulations. Then we'll turn to Greg Udell from Indiana University, who's going to discuss macro-prudential policy tools, which have been most popular in Europe to this point, but have not been implemented in the United States. And then finally, our last panelist, Santiago Carbó Valverde, is going to provide some thoughts about policy issues surrounding the incursion of technology firms into financial services. There's sort of a fintech leaning with that. So without further ado, I'd like to turn things over to Bob. The way we would like to do this is give each of the presenters about 20 minutes. I'll try to keep time as best I can. And that should leave us 20-25 minutes at the end for Q&A with the audience. Okay, so I'll turn it over to Bob. You don't handle it. I guess it's
Well, thank you, Scott, for including me on the panel. Thanks for inviting me. Happy to be here. And I'm going to take Scott at his word. He said it's good to get a panel together and offer a little bit of wisdom. I think that were your words. Offer a little bit of information, and I'm going to hold him to his threshold. Okay.
Always set the bar low, Bob.
Well, you set the bar low. So I'm going to try to
see. You can blow right over it.
Yeah, I'm going to try to exceed it. That's the idea. Okay. Okay, so the financial crisis. I think, in three parts. Right at the beginning of the financial crisis, we had an asset bubble that popped. The real estate bubble burst, and that's at the beginning of what we now refer to as the financial crisis. At the end, of course, we had a whole bunch of commercial banks and other financial institutions fail. Okay, but in the middle, we have actually this thing that we call the financial crisis, right? Which is really short-term, the malfunctioning of short-term credit markets. Investors in commercial financial market, financial institutions, commercial paper, and other short-term credit instruments, they didn't know what the true value of of these real estate-based financial contracts that financial institutions had invested in. They didn't know the value of it, so it's hard to value them, and they, one place more than one bank more than another, they refused to roll over their positions financing these these real estate-backed assets. So the financial crisis was a liquidity issue, was a liquidity scenario, a liquidity crisis, and very much unlike the financial crises that bank regulators and banking economists have thought about. You know, it wasn't necessarily just a blowout of asset value and ending up in insolvency. It was something a lot more than that, a lot more fundamental than that. So the regulatory response in the short run and the long run, central banks did what central banks do, both in the U.S. and in Europe. Right, we provide liquidity as much as necessary to try to allow markets to function. Okay. In the longer run, and that's where we are. Obviously, 10 years later, we're in the longer run. We have a regulatory response, and the regulatory response, the way I look at this regulatory response, is now. This is big picture. We have bank balance sheets that are now double constrained by regulation. We have the capital minimums, which have become tighter and tighter over time, and we all know about this. It's been, if you go back to when the U.S. First put mandatory minimums on bank equity to asset ratios back in the early 80s, through 3 rounds of Basel. Ending up with much higher capital minimums, much different kinds of capital rules, including macro-prudential things that Greg is going to talk about. We're used to thinking about regulation of banks in that framework. I don't know how much of our research on bank regulation starts with that framework. Well, now we're laying this other threshold, other minimum regulatory threshold over top of all those balance sheets. And we don't know a lot about how banks operate when when the capital ratio is binding, but the liquidity ratio is not binding, when the liquidity ratio is binding, but the capital ratio isn't, or when both of them are. We have some theory papers that model it, and of course they don't all come to the same conclusions here about whether liquidity and capital are strategic substitutes or strategic complements on balance sheets. We don't know. I find it quite interesting that we've written very complicated, not complex, and I'll show you that these two new liquidity minima in Basel III are not at all complex. They're very simple. They're just complicated. These rules, the complicated rules were written. These formulas were written without real strong theoretical agreement about how they're going to work in tandem with each other. These two liquidity minimums are the liquidity coverage ratio, which is basically about bank runs. Do we have enough liquid assets on our balance sheet to withstand an unexpected run during a liquidity crisis? And of course, that's that's traditional 60-year-old banking theory. We've been studying that for a long time. The net stable funding ratio, or the NSFR, is about the balance sheet on hold. How stable is this thing? And its roots go back to matching maturities on both sides of the balance sheet. So these are two different kind of tools. Interestingly enough, in Europe, all banks, almost all banks, have to correspond, have to behave above the minimum LCR and NSFR minimums. In the United States, we're just making these liquidity standards binding for large banks, above $10 billion, above $50 billion, above $250 billion, different rules for different banks in those categories. But for banks smaller than $10 billion, we're not regulating liquidity, we're just doing what we've always done, we're supervising liquidity. And we're going to keep supervising liquidity for small, medium, and large community banks. We're going to keep doing that. And if I say it should be adequate for small banks, you're going to say, well, why did some of them become illiquid then? Well, it would be a failure of supervision, right? And I think that's how we should look at what happened here. In terms of liquidity, it was just a failure of supervision. We've known for a long, long time for Now, you measure time different ways. I'm going to measure this in terms of generations. Bank supervisors have, and bank analysts and banks themselves have looked at liquidity ratios for generations. And I'll show you how the NSFR is really just a very, very fancy loans to deposit ratio. So it's not that we haven't had rules or sensibilities in the past, it's just that in the supervisory setting, we allowed banks to become too illiquid. So this is the liquidity coverage ratio. The idea is that we want to have this ratio to be greater than 1. A bank should always have this ratio greater than 1. Now, the thing in the numerator is pretty simple: high quality liquid assets. We know what they are, right? Cash, any securities you can sell quickly without taking a loss. These are high quality liquid assets, Fed funds sold, etc. And they provide our liquidity for the bank. What's in the bottom, though, is an estimation. We want to estimate how much cash would flow out of the bank within 30 days during the beginning of a financial crisis or an illiquidity scenario. Now, this is not, we're not treating this like a Basel II internal models base. We're not allowing banks to estimate this themselves by and large. There's a formula. There's a formula for this. I want to point out here that this looks just like the ratios you've taught your students. If you ever taught an accounting class, a financial analysis class, or a basic corporate finance class, I think if we take a look at the Basel III liquidity coverage ratio and compare it to what the textbooks and what analysts call the quick ratio, the numerator is pretty much the same thing, right? Current assets minus those current assets that aren't necessarily liquid, so we've got high quality liquid assets. In the denominator, we have a difference. The difference is in the quick ratio, we have current liabilities. We know when they're contractually over, and we have to either pay retirement liquidity or the liability to replace it. We know that. The problem with banks is that we don't know how fast depositors are going to execute their put options and take their deposits out of the bank. Or, let's not forget, execute the put option in their loan commitment, in their line of credit, and take liquidity out of the bank. That's something we don't know. Here's basically, this is very simple. You can look up at basically Basel.com and find out the formulas in their gory madness. The idea is we want to have this greater than 1, where we have enough high quality liquid assets to sustain 30 days of extreme cash runoffs. The cash outflows, the second bullet is the important one. The sum of all bank liabilities and off-balance sheet commitments, each weighted by the likelihood of running from the bank during a stress scenario. Now, if anyone knows, I'd like to talk with you. What did the folks at Basel putting this together? Were models estimated to try to find out what these weights should be, or were they maybe done by putting your wet finger in the air and seeing what you think this should be? I would like to know that. I suspect there was some modeling going on, but I've never been quite sure about what that was. So this is a typical kind of highly regulated, kind of Basel-like formula where we take a bunch of things from a balance sheet, we put weights on them, we get a weighted sum, and the weights may or may not be correct. I'll also point out that anytime you have a regulation like this at the margin, when it's costly to comply, there are incentives for arbitrage, for regulatory arbitrage. So that's an issue we might have to think about. Essentially, complying with the liquidity coverage ratio is regulators forcing banks to self-insure, right? To self-insure against liquidity runoffs here, right? In most scenarios, the banks are going to be too liquid because we don't have a crisis happening. They're supposed to hold enough liquidity to be able to handle the crisis. Well, that involves an opportunity cost. Right now, interest rates are really, really low, so the opportunity cost is really, really low. When interest rates go up, I think it would be quite interesting to see what happens. Of course, at that point, if there is opportunities for regulatory arbitrage around the different kind of assets that are considered high-quality liquid assets, I would expect banks to try to take advantage of that if they could. Okay, here's the second of the 3 ratios, the Basel III's net stable funding ratio. Again, it's a ratio where I'd like to start in the denominator here, required stable funding. Required stable funding, these are assets that require stable funding, and that's at the bottom of the slide. As you might guess, this is about matching maturities. Assets that require stable funding would be assets that are longer term or illiquid. They're going to be on your balance sheet. You have to, this regulation asks the bank to hold against those long-term illiquid assets, long-term illiquid liabilities, matching maturities, in a crude sense. You can see that each of these different categories, and I've summarized some because the list is a lot longer than 4 or 5 bullets for each of these categories. You can see that longer-term non-performing loans, loans of financial firms, loans secured by real estate, C&I loans, consumer loans, these all have very, very high weights. These are the things that count, really count from your balance sheet. They qualify as required, as assets that require stable funding. When we get to shorter term, less liquid assets, the weights go smaller. We're not so concerned about having long-term funding for those. So go up to what constitutes available stable funding. At the bottom, we've calculated a weighted average of our assets, weighted towards stuff that needs stable funding. Well, what's stable funding? Well, we know what stable funding is, right? It's equity, long-term debt, and core deposits. Yep, that's what it is, right? So these are stable funding. This is funding that you don't have to worry about it running, right? So that's the important thing. So you want to finance your long-term and liquid assets with that kind of financing. Let me point something out here. The green stuff here, the heavily weighted stuff is almost all green at the top. Those are core deposits. We call those core deposits. We've always called those core deposits. In the bottom, these things are essentially loans. This is the loan portfolio. Okay. So for generations, banks have calculated something called the loan-to-deposit ratio or the loan-to-core deposit ratio. Banks have always said this is very important, and they've always thought about this as a measure of the liquidity of our balance sheet. So whether it's the loans-to-core deposit ratio or the simpler loans-to-deposit ratio, the bigger this gets, the more illiquid your balance sheet is. Right? In the net stable funding ratio sense, you don't, as this ratio gets bigger and bigger and bigger, you don't have enough stable deposit funds funding your loans. So as the ratio gets bigger, your balance sheet's less liquid. So when this happens, when you have not enough deposits to fund your loans and you're funding with other things, you have a funding gap. Okay, this is pretty simple. Loans minus core deposits. We often call this the funding gap. We have to fund it with something, right? Well, what's the typical 2 basic ways to fund this? We can fund this gap either with short-term borrowing, which reduces the liquidity, which makes our balance sheet less stable, makes us more liquid. And or we can just reduce our liquid assets, sell liquid assets, and lend that out. Okay, which of course also puts more stress on having long-term stable funding. Okay, so if we set these two together, equation 1 is our funding gap. Equation 2 tells us the basic ways we plug the funding gap. Solve it for the loan-to-core deposit ratio I've been talking about. It looks pretty sensible, and this is really the logic behind the NSFR as well. If your short-term, on the right-hand side, if your short-term borrowing is just enough to fund your liquid assets, in other words, if the short part of your balance sheet is balanced, that term on the right-hand side equals 0, you've got a pretty well-matched balance sheet, and the loans-to-core deposit ratios would be 1 or around 1. Okay, so that's the basic idea here. This is not sophisticated. Years ago, a colleague of mine told me there's a difference between complicated and complex. Complicated means it's needlessly complicated. Complex means it's really difficult to understand, right? And this is either complicated or complex. It might be more complex than it's complicated. The NSFR and all these weighted averages. This is complication. There's nothing complex about it. It's a very simple idea. So I'm claiming that the core deposit ratio in NSFR is a good substitute for the NSFR. So let's take a look at a couple of pictures from research I did with Karen Jang. This was a 2016 publication in the JBF. We calculated the NSFR for all the banks in the United States over 2.5 decades. Now, these banks did not have to comply with the NSFR, right? In fact, for most of the years in these data series, the NSFR didn't even exist. It hadn't been invented yet. Okay, but this is what happened to it over time. Well, first of all, you see the ordering. The largest banks at the bottom had the lowest value for NSFR. They're clearly illiquid. The balance sheets, according to this Basel III measure, would have been deemed illiquid. They're below 1. And as we move up to the top, we move to smaller and smaller banks. Smaller banks are more liquid. Not surprisingly, they can't access public capital or credit markets in order to fund their balance sheet. So they self-insure. Over time, and this is the amazing thing, over a couple of decades here, liquidity was falling and falling and falling and falling, almost in a straight line, almost monotonically for all of these banks. Then when, in 2007, that's where the red lines hits and the asset bubble pops, after that we see banks responding by becoming more liquid. Okay, various reasons for that, various stories we can tell. Well, the next slide shows us the loan to core deposit ratio. Back. Yeah, here it is. This looks pretty much the same, right? It's just that the loan to core deposit ratio has the stable funding on the has the stable funding on the bottom, has the required stable assets on the top. They're ordered the same way. They increase almost monotonically over time. After the financial crisis, banks all become more liquid rather than less liquid. So this is almost like, I feel like I've proved my point. They're not exactly the same thing, but this is not a new concept. We've been looking at liquidity for a long time. We just have never required banks to meet minimum standards for these ratios. So just to finish up here, there's an awful lot of literature on liquidity. It's starting to grow, not surprisingly, and I want to organize it into three different categories. The first one is why banks exist and the role for liquidity risk. We all know that banks exist. What they do is they transform assets, right? By doing that, they become illiquid. That's what banks do. They fund illiquid assets with liquid liabilities. We know this from decades and decades of research. And it's all where we start when we begin to think about the production function of banks. More recently, if you're interested at all in this area, this is where I'd start. I would start with the Kasha, Rajan, and Stein paper, which is a theory piece, and says that when you think about banks, banks produce liquidity on both sides of the balance sheet. They produce liquidity for depositors, right? They liquid liabilities. They produce liquidity by extending lines of credit, all right? And they hold liquid assets against both as a liquidity hedge against both of those. Hopefully, the folks wanting the deposits back don't ask for it back. At the same time, folks with lines of credit want to draw down the lines of credit. Hopefully, they don't happen at the same time. And since those two demands on liquidity are happening against the same set of liquid assets that banks are using as the hedge against that liquidity risk, if they're closely correlated, the bank's in trouble. If they're not closely correlated, there's this synergy that the bank has, a joint production for one input, liquid assets. So Vitav and Strawn did a paper where they showed not only are they not closely correlated, the demand on one side of the balance sheet for funds, on the other side of the balance sheet is actually negatively correlated. They found that during times of stress in credit markets, investors came out, put the money in deposit accounts, and non-financial firms now had trouble accessing the commercial paper market because the investors had all fled. So they go to the banks to draw down their lines of credit. So just when they're drawing down the lines of credit, that's when deposits are flowing into the bank. So they call it a natural hedge. A little less than a decade later, Acharya and Moore wrote a paper and said, yeah, that probably is true, but the only reason it works is because deposits are insured. We've insured deposits. So I think there's more work to do here. This is a very interesting line of 3 papers, and as we go forward and collect more data, particularly during a regulated time when liquidity starts to be regulated, I think it may pay to think about that. A second set of papers I'd like to point out on regulating bank liquidity. King had a paper, which he did this before Basel II was imposed, but as it was being proposed, and he said, he looked at banks over 15 countries, and he said, for banks to go where they are now, and change their balance sheet to what it needs to be to comply with these 2 new regulatory minimums, they're going to lose 70 to 80 to 90 basis points off their net interest margin. So once again, right, having liquidity insurance is costly. Having liquidity insurance. Karen and I, this is the paper that those 2 pictures came from. We found out, as you saw in the pictures, that banks targeted not just the loan deposit ratio, but they also targeted the NSFR, even though it didn't exist yet. They behaved in a way that was compliant, that was consistent with the NSFR. So they targeted it. When they got out of line, above it or below it, they adjusted back at about 25% per year. They closed the gap. Relatively fast adjustment speeds for partially delivered models. And this is nice paper by Lev Bertowski. He said in his model, he says banks hedge liquidity risk 2 ways. They hold liquid assets, but then another way they can manage their liquidity risk is by being transparent. If credit markets know how good your assets are, there won't be a big shock, right? They'll always know you won't lose access to your liquidity all at once. But they point out that if the regulator comes along and imposes more liquid assets, these banks have less incentive to be transparent. So again, another cost to regulation. I think when we talk about regulation, it's very hard to find the cost of regulations. Lev proposes a cost of regulation, although he doesn't measure it. And then finally, I've already talked about this, the interdependence of bank liquidity and bank solvency. I think that's where the real money is in this research, is to try to now model banks and then measure what banks do while they have both one, the other, or both capital or liquidity rules binding. And Walther and Charlie's paper and then our paper, we all kind of come to different conclusions. The first 2 are theory papers. Our paper is an empirical paper, but the 3, I'm going to say 2 out of 3, with 3 reasonable papers, and we all in the end tell different stories about capital regulations and liquidity regulations play well or don't play well together. So I think this is why. So I took up my full 20 minutes. I didn't think I was going to, but anyway, thanks for having me.
All right, thanks, Bob.
Thanks, Scott, for inviting me to be on this panel. What I'd like to talk about, you'll see some overlap a bit with what Bob talked about. These macro-prudential policy tools with a specific emphasis on their efficacy and unintended consequences. And just by way of overview, I'll start by talking about the motivation for macro-prudential policy tools. Definition, and talk a little bit about the toolkit, if you will, and then provide some context, and that'll be linked to the global financial crisis, not surprising, at least current interest, much increased interest in macro-prudential policy tools. And then I'd like to discuss some of the issues associated with them, and then in a very self-serving way, I'm going to talk briefly about 2 current papers that I have on macro-prudential policy that will dovetail with some of the issues associated with their implementation. So, by way of motivation, in short, the purpose of macro-prudential policy tools is to mitigate systematic risk, and interest in this has, I think it's fair to say, exploded since the global financial crisis. They are distinct from micro-prudential policy tools, such as, for example, detailed firm-specific risk assessments by bank examiners. The toolkit, if you will, contains a number of different tools that can be put into 5 categories. Beth has done this. Broad-based tools, household sector tools, corporate sector tools, liquidity tools, and structural tools. And briefly, we can think of broad-based tools as tools like the countercyclical capital buffer, and dynamic loan loss provisioning, which I will talk a little bit about later. Household sector tools. Two of the most common are LTV and debt-to-income caps. Corporate sector tools, a good example of this would be limits imposed on credit growth to the corporate sector. Liquidity tools, this is where I dovetail pretty closely. We've already talked about, including, for example, the net stable funding ratio. And finally, structural tools like SIFI regulations to address contagion problems. So that's what macro-prudential policy is. When I think about it anyway, I think about it in the context of pro-cyclicality and bank behavior. And actually, there's a fairly long literature on this, empirical literature, going back at least to Bordeaux et al. 2001. There are a variety of hypotheses about why lending and bank behavior is pro-cyclical. There are expansion-oriented hypotheses, downturn-oriented hypotheses. Valverde and I explored in a paper in the JFI the institutional memory hypothesis. So there's no shortage of hypotheses about that. Also, the context, we've got a history of financial crises, including two big recent crises, the 1990 Japanese crisis, the 2000 or 2008, depending on where you peg that, global financial crises, but we've also got the Nordic crises and the Asian crises. And another piece of the context is that these crises have sort of illustrated the limits of traditional macro-prudential policy tools with respect to systematic risk and building risk in the system. And we went into the crisis with inadequate macro-prudential regulatory infrastructure. There was some infrastructure, for instance. So, more so in the Fed, there wasn't the financial stability section, but there were financial stability sections in Europe. For instance, the Riksbank had one prior to the crisis. How effective that financial stability section is a discussion for another day. But so issues associated with the implementation of macro-prudential policy tools, at least the issues that I'd like to talk about, are first, the efficacy. They work. And closely related to that, when do they work and under what circumstances do they work? Second thing is unintended consequences. And finally, leakages. And we're starting to build up some research, and that research is correlated with the fact that a lot of countries have developed and implemented macro-prudential policy tools. And I think there's plenty of room for new research. The IMF has just released last year the first of an annual survey that they'll be doing, where they survey their members. And that, I think, research, or that data set will further improve the research that we have about these tools. Now, on the issue of do they work, to give you one example, the implementation of dynamic loan loss provisioning, which I will talk about a little bit later, a self-serving discussion in Spain, there's evidence that it helped mitigate the subsequent global financial crisis-induced credit crunch in Spain. That's the Jimenez et al. Paper in 2017. When do they work? A very interesting paper by Aikman et al. Very recently that sort of talked about when they work, how they would be implemented, and sort of compared the UK's, as a feature example of this, the UK's Financial Policy Committee with the Financial Stability Oversight Council. And one way to think about these two is if you think about which of these two countries has the more muscular infrastructure to implement macro-prudential policy tools, you would put the UK very muscular, the US very weak. And one way to think about that is just by example. the upside, does not have the ability to implement a macro-prudential policy tool like LTV caps. The UK's Financial Policy Committee does have that ability, and that paper goes into a lot of other examples that I think are useful in thinking about that. Unintended consequences. I believe the Swiss were the first to implement countercyclical capital buffers, and a paper several years ago looked at that and found that capital constrained and mortgage specialized banks raised interest rates. Now, we could argue about whether that was an intended or an unintended consequence of that. But if those interest rates are associated, actually higher interest rates, with higher risk taking on the part of the banks, then that certainly would fall, I think, into the category of unintended consequences. I'll have a little bit more to say in my own 2 papers I'll talk about unintended consequences. Leakages are loopholes. So, for example, if a country, say a Scandinavian country, for instance, imposes an LTV cap on mortgages, say an 80% loan-to-value ratio, that you can't exceed that, and that's all they do, then what a bank might do is to make a mortgage for 80% of a $300,000 purchase, but then make an unsecured loan to finance the rest that the borrower can't finance, therefore doing an end run around the mortgages, and that in fact happened. And so, but there are all kinds of examples we can think about leakages associated with macro-prudential policy. Countries that have a big foreign presence, for instance, and possibly through those banks circumvent those things. So I have 2 papers on these issues. One related to doing work, and both of them talk about unintended consequences. So my remaining time, I'll talk about my own research, but to sort of illustrate some of these things. So first paper that I'm talking about is lending procyclicality and macro-prudential policy evidence from Japanese LTV ratios, loan-to-value ratios, co-authored with Rito Ono and Hiro and Uchida and Ichiro Sueji. And the context here is Japan, and sometimes we forget, but the crisis that mirrored in many ways what happened in the United States beginning in 2007 happened substantially earlier in Japan. I find those comparisons sort of interesting. 2 big investment banks failed in the United States, 2 big investment banks in Japan, and you can go on, and they both had real estate at their core. In this paper, we look at an alternative application of LTV caps in the special case of Japanese business lending. Basically, we're looking at the counterfactual. If an unconditional cap on real estate lending in Japan had been imposed, would it have been effective? Would it have been binding? Is what we're going to be looking at. As probably everybody knows, there was a huge real estate bubble in the 1980s in Japan that popped. The index is around in April of 1990. Huge exposure to real estate lending, and different from the U.S. experience. This was particularly acute in the business sector, which caused significant loan charge-offs and ultimately failure and consolidation of banks in Japan. We have data that allow us to look at collateral posted for business loans. Both collateral posted by the entrepreneur, which could be called outside collateral, because this is real estate not owned by the firm, as well as the firm pledging its own real estate for collateral. Prior to the crisis, business lending in Japan centered on something the Japanese call the collateral principle. The business had real estate to pledge as collateral, they could get a loan. And it's important to note that at that time, Japan did not have a modern set of laws on security interest on movable assets. So it was not feasible to pledge things like accounts receivable and inventory in Japan. They only passed that law about a decade ago. And so that's why real estate was so important at that time. far as we know, we're the first study to analyze LTV ratios in business lending using disaggregated data. And we address both the issue of efficacy and unintended consequences. So our key tests are, we analyze the cyclicality of LTV ratios in business lending. We do some univariate tests where we have data that allow us actually to go back all the way to 1975 and look up to considerably after the crisis of 2009. And we ask a simple question: are LTV ratios pro-cyclical, which is the conventional wisdom in Japan, or was before. And then, starting in 1990, some additional data allow us to do multivariate tests where we can ask a more complex, I'm not sure, more complicated question for it. Are LTV ratios pro-cyclical controlling for loan borrower-like characteristics? Then finally, we also analyze whether in fact, ex post, the performance of high LTV borrowers and how that compared to low LTV borrowers, asking a simple question: do high TLV loans actually perform worse? Which is sort of the root of the idea of putting a cap on LTV. So what we're basically asking is if regulators in Japan had put a cap, unconditional cap, on the loan-to-value ratio, meaning that this is to borrow about, say, 8% value of real estate, would it have worked? Our data is sort of interesting. I won't spend a lot of time on this. We don't have a lot of time, but we get information from the largest credit information provider in Japan, TDB, which is sort of like Japan's Dun & Bradstreet. This yields 420,000 plus business loan observations. The data set also includes detailed information on collateral registered from 1975 to 2009. There is a survivorship issue here, but this is data that I don't think exists anywhere else in the world. So it's flawed, but it's interesting. That includes property specifications, ownership, security interest on loan amounts that are registered. And we calculate the LTV ratio using all this data, where the numerator is the loan amount, which we get from TDB. And then the value we estimate using an hedonic approach. We use data from the Japanese Ministry on prices and property characteristics, and then apply those parameters to the specifications we get from TDB on the property. So the key results are we find that LTV ratios in business lending were not pro-cyclical, but rather counter-cyclical. We find this both in the univariate and the multivariate analysis. Therefore, unconditional LTV cap would not have been binding. The ex post performance of high LTV borrowers, and these are business borrowers, was not poorer than low LTV borrowers, interestingly enough. So our results are not consistent with conventional wisdom in Japan about lax lending standards. They cast doubt on the application of a simple LTV cap, and in terms of efficacy, it doesn't look like an unconditional cap would work because it wouldn't have been binding. And in terms of unintended consequences, because high LTV borrowers weren't necessarily risky borrowers, that presents an issue. I don't have time to go through all these, but this graph sort of shows you the situation. And basically what we find is during the bubble period, which is the shaded period, LTV ratios are actually falling in business lending, not rising. And then just the opposite once the crisis started. One thing I will say, there's almost no discussion in the literature about LTV ratios on business lending or consumer lending outside of real estate. But we can think about such things. So in consumer lending, auto loans, for instance, and RVs, I've never seen data on LTV ratios, but I would not be shocked if they are pro-cyclical. We can also think about equipment loans. And I used to be an asset-based lender lending against accounts receivable and inventory and sort of followed that space. And to me, it's anecdotally, I'm talking to bankers who do this, I've seen some evidence that how much a bank will lend against accounts receivable, which is an LTV ratio, and how much it will lend against inventory in an asset-based platform. I've seen that rise during booms and fall during busts. All right, last paper, second paper. How much time do I got?
3-4 minutes.
Okay, got it. This is a paper with Manuel Luca, Lars Norden, and Joe Pacelli. And we look at countercyclical prudential buffers and bank risk-taking. And like the Jimenez et al. Paper, we're going to use Spain as a laboratory. We'll start with just noting that risk-taking is for banking. Dynamic loan loss provisioning imposes a method of loan loss provisioning that estimates provisions using aggregate data that is not related to information about specific borrower risk or the portfolio risk associated with the loans themselves. And we conjecture that the mandatory addition of dynamic loan loss provisioning leads to a reduction in timely provisioning by timely banks and forces them to sort of get back to their preferred risk-return space by adjusting the risk of their loan portfolios. So unlike less timely banks, timelier banks have a preference for preserving their timeliness. That's taken away when this dynamic loan loss provisioning is imposed, so they can only do this by actually changing the risk of their loan portfolio. So the accounting timeliness is consistent with the risk of their portfolio. Our laboratory was Spain's introduction of dynamic loan loss provisioning in Spain in 2000. And this was the first attempt to reduce the cyclicality of loan loss provisions. This is a banking system with substantial heterogeneity that allows us to do a bunch of things that we can't talk about here. That's what dynamic loan loss provisioning looks like. And there's just basically this component, which is on the right-hand side, which is superimposed on banks by the Bank of Spain, and it's set based on macro factors, and it has nothing to do with the risk profile of the bank itself. And what you can see is that gap there with that red line it made a big difference in loan loss provision. And so we test three hypotheses associated with this. The first hypothesis is banks exhibiting high levels of timely loss provisioning increase lending to borrowers with high ex-ante risk relative to other banks following the introduction of dynamic loan loss provisioning. Our analysis supports that hypothesis. We measure risk, and we have data on individual banks, individual firms in Spain, and we can calculate their financial data, we can calculate their Z-scores. So we find evidence based on those Z-scores that indeed timely banks made loans to riskier borrowers. Second hypothesis, banks exhibiting high levels of timely loss provisioning increase lending to borrowers with low accounting quality relative to other banks following the introduction of dynamic loan loss provisioning. So we look at whether they keep their auditor, basically a Big Four auditor, or whether they switch. And the propensity to switch auditors is higher for timely banks. Looking now, they increase their risk to get their risk portfolio associated with their dynamic provisioning. And also in the accounting literature, firms that report small profits tend to be firms that are trying to manage their financial statements because they're of less quality. And finally, hypothesis 3, banks exhibiting high levels of timely loss provisioning experience more loan growth relative to other banks following the introduction of dynamic loan loss provisioning, and we find evidence supporting that. So our conclusion is that the dynamic provisioning experiment in Spain yielded unintended consequences. That is, these banks that were timely in their accounting actually took more risk. Now that doesn't mean we're concluding that this was a failed experiment, because other evidence showed that after the crisis materialized, more credit was available than would have otherwise been available. So all we're saying is we have to weigh the benefits from the costs, and this suggests that there was, in the form of unintended consequences, some costs. So these two papers sort of illustrate the kinds of things that I think we need to think about going forward, as so many more countries are adopting these macro-prudential policy tools. That's it.
All right. Thanks, Craig.
Thank you, Scott. Thank you for inviting me to this panel to talk a little bit about something a bit different, but also linked to regulation and deregulation issues, which is the current debate about regulated financial institutions and regulated fintech and big tech. That will be the structure of my talk about cost of financial intermediation and the erosion of these tech players, some ideas about competition, information sharing and regulatory actions, the big tech finance models and challenges for regulation, and then the final remarks will be on this new concept, or relatively new concept, the subtech phenomenon. I think when one looks at the cost of financial intermediation over a long period, as Thomas Philippon does in his paper published in 2015, he basically claims, even after taking into account the various adjustments that he takes, the unit cost of financial intermediation appears to be as high today as it was around 1900. This is possible. Advances in information technology should lower the physical transaction cost of buying, pooling, and holding financial assets. And what I find particularly interesting is a plausible explanation is that my measure might fail to capture the social value of information production in financial markets. So that's the aspect we are going to focus basically on, social value of information production. And how new players probably, because this fact of this element came into to compete with banks. We are going to consider two. We're going to basically the fintech companies, which cover a very broad range of activities, not only banking or payment services, insurance, medtech, real estate. There are new, very wide, a broad scope of new activities. But my impression, at least in Europe, is that fintech, if you look at the census of these companies, are relatively small. Most of them have equity of less than 1 million euros, at least in Europe. In the US, it's a bit different. Probably in Asia as well. You consider financial or something like that. But so fintech are going to be considered like smaller players, smaller competitors for banks, and big tech, which are Google's, Amazon, Apple, Microsoft, and others, Facebook. They would be the very large one. I will refer them later. There is some recent literature on, that tentatively is looking at this competitive landscape. I'm going to refer to Valverde's recent work on the on how banks can face the competition from fintech, and the next slide from big tech. Banks, incumbents could do two things. Banks accommodate, fact cut. So particularly if they have or they face high switching costs, which are, they are eroding. Of course, switching costs is still there are switching costs in banking services, but they are lower than most of the past. And probably they also can gain interchange fees paid to them by new service operators, so they may be quite happy with that. Also, a very conservative approach from fintech could be to commit to be small, to retain the small but without employee. So no go for banking license, for example, P2P lending that serves some banks and the population, and form some sort of partnership with banks. Another possibility is to try for banks, for incumbents, to prevent entry. Okay? Shut down the great access to infrastructure. And the fintech will also be aggressive by trying to entry as some banks, neobanks, or digital banks have done in Europe or other places, Revolut. Entry as a digital bank, less likely given less likely event given the high compliance costs involved. And another possibility, it is happening everywhere, to consolidate or to sell to the banks. A very good idea finishes being a $10 million for the owner of the fee. So banks can also launch their fully online banks. Something that is, I think more important for the future and more challenging for banks is the competition, the potential threat of the potential competition from big techs. So far, I mean, banks have tried to accommodate partnerships, provide specialized unique banking products and services, and big techs as well, partnerships. However, in the future, there seems to be potential leeway for harder competition. Banks may try to move from brick and branches banks to more platform marketplaces. I know that is something that many employees, the staff is not happy to hear because of course they are used to that, but it's a possibility or a clear possibility for many banks. Banks could profit from, let's potentially hypothesize that, superior trust from customers regarding data protection. Maybe we trust more a bank than Facebook. We don't know. I mean, the banks could try to benefit like that. Better regulatory navigation skills and similar lobby power than big tech, particularly with regulators and supervisors. And in this context, they cannot match big tech's bundling, cross-subsidization strategies, and the possibility that big tech have with complementarity, financial and non-financial products, etc. Even if banks have some network effects. Big tech could also, in a more aggressive approach, could compete head-to-head, become banks, intermediaries, bundling their offerings and exploiting economies of scope, or not to set deposit to avoid regulation, maybe that's always a possibility. Or also possibilities multi-sided platform and gatekeeper monopolized interface with customers. I think big tech is the elephant. Big tech entry banking could be similar to the path they have already followed in other businesses that they have already monetized. Probably their business case for the financial products are still not so strong as in other areas, but here is possible. They could do that by vertically integrating upstream or upstream, discriminating in favor of their own upstream businesses in their core platforms, leveraging dominant services and or data superiority, artificial intelligence, etc., to attack adjacent markets. Eventually, this higher, superior artificial intelligence, big data, whatever, I mean, this big tech could end up having like two solutions, which are not very good for banks. Market tipping, which rivals by getting more and more consumers on board, taking advantage of the platform. Are we many years away or many months away from, saying Siri or Alexa or whatever, please, I want to voice, I want to go on holiday with my family, my son, 13 years old, my daughter, 11 years old, we are 4, we want to go to Bahamas, and we want this run also an option to get the best credit for this travel, and we want to cover like 70% on the total. Probably Siri or Alexa, whatever, they would be able to very quickly do this. And this, if this happens quickly, of course, one could say, well, banks can also set up their own personal, their own voice assistants. Yes, but I think they're running behind us, as one of my hypotheses, working hypotheses say in a minute. So it's a world in which banks will see many of the fees, or many of their commissions, many of their revenue being taken away from these superior technologies, probably, or at least with a better user experience. Another possibility, of course, in terms of cloud computing, etc., is that these companies become a monopoly. So they are the only provider of offering certain services. That's something that you need to keep in mind. So in any way, this is going to, as we all know, supervisors and regulators are facing many difficulties to create a level playing field. Of course, more actions are needed from regulators, also from banks. Banks are, as I will say on the next slide, are falling behind probably the potential competitors. Big tech and fintech represent an industry that covers digital innovations and technology-enabled business. This is more innovation in the financial sector. Such innovations have disrupted existing industry structures and will blur industry boundaries. They can and that's what they claim, more democratic access to financial services, but also create significant privacy, regulatory, and law enforcement challenges. So probably banks are offering, so far, tighter privacy protection and probably law enforcement, but that's one of the things that I'm saying, and that's one of the issues that probably will be at stake. So regulators need to assure a level playing field in solvency regulation, but also in information sharing, in data protection. In Europe, this is happening. Banks still need to develop this information-based technology, but there are important barriers to this, mainly coming from confidentiality and information safety. So some of these regulatory and industrial solutions that are mentioned by the European Commission, and this very interesting paper by Manuel de la Mano and Jorge Padilla, already forthcoming, I think, published in the Journal of Competition, is that some hypothesis, working hypothesis, Google and Microsoft as main cloud computing services. What will it mean? It means that now the bank examiners inspector will have to go there and check whether during lunch, colleague told me that they are already doing that, not the same way as they say inspectors or examiners to the bank, that they stay there for weeks or something like that. So that's a possibility. Google assures that it will only cooperate with banks as a service provider so far. Another interesting hypothesis is banks have software, hardware, and algorithms, of course, but different human capital, more admin, economists, less psychologists, data engineers, etc. Banks are far behind in artificial intelligence investment. It's very interesting, and what are the consequences for that? Banks need to develop joint initiatives in artificial intelligence and cloud computing to compete. Are they, is there a possibility for banks to really become, if they join forces to be able to compete with these huge giants? I think it's going to be difficult. So there are two big tech models I think is interesting to look at. The Asian model, China basically, with high concentration in the big tech industry, not so global, but steadily expanding. Almost no rules of consumer info protection. It's a different situation compared with the US and particularly with Europe. And they have super apps as a tool. The US model is global. They follow maybe to the extent of the consumer protection as in Europe, that is very it's very tight in Europe, but it's also very important here. There are challenges of info and international tax treatment, little competition, and apps are more clustered, compartmentalized, but progressively more integration. This is a huge, this is my last 2 slides again. This is a huge challenge for regulators and supervisors. First, because probably they don't have the resources, human resources, material resources to compete with an army of data engineers that any of these big tech companies have. First, probably the antitrust authorities or the financial supervisors would need to understand what these companies do. And they may understand it, but they go much slower than what these companies can. And the thing as well, as I'm going to mention, is difficult. First, you have less resources, and if you don't coordinate all the different parts of regulation and supervision, it's going to be difficult for supervisors to try to control and to supervise this problem. Banks complain that, and this in Europe, we have a regulatory initiative, which is called PS2 Directive, Payment System Directive number 2, which is going to allow third parties to get, if the customer allows it, to get all the information from your bank. Of course, you have to authorize it to the customer, and they will be able to offer you new services. That's a huge regulatory event. It will take probably, it was supposed to happen this year, but there is a transition period that is going to be at the end of next year in most countries. However, the other way around is difficult. How are we going to get some data from these Googles, Amazon, etc.? They also have it. They are going to get all the bank data, or they are potentially able to get it. And what about the other way around? It's tricky. So at least now we have the debate about data protection, also antitrust, issues, but the main topic here is the financial stability issues. This is the main topic in this time. And now we have this subtech phenomenon. It's a very recent paper by the Bank for International Settlements on the insights on policy implementation of this subtech that is going to try to coordinate all the supervision authorities. You see, I mean, regarding the data collection, I think this graph is from BIS or something. And it includes reporting, virtual assistant, data management, anti-money laundering, everything. Okay, micro and macro-prudential. Okay. Which authorities, as is the last idea, in the world are already taking this global perspective in this new world, which technology and information is so critical? Well, that BIS paper offers, which authorities are doing. I mean, this survey 39 national authorities in the world, and half of them no strategy reported regarding this subtech of this coordination. 11 of the 39, 20% are already taking this subtech roadmap. This one. Okay. And the other 23% are struggling and to get digital transformation. So there is a long way ahead. And probably a level playing field is going to be it's always been very difficult to get, but I think it's going to be more difficult in the future.
Thank you very much, Santiago.